Hi, we're talking about Your Money Matters on NDTV Profit, and my name is Alex Matthew. Now, there is one investment that if you had made over the course of the last 10 years on a compounded basis would have done better than an investment in the Nifty 50, and that means that it would have done better than quite a few other investments. And some of you will already know what I'm talking about because you've invested in it, whether you like it or not. You've bought gold. And if you look at the compounded annual growth rate of gold over the last 10 years, then when it compares to the total return index of the Nifty 50, gold has returned about 13.9% and the Nifty 50 is at 13.15%. We'll talk about why gold has been such a spectacular asset class and what you should do at this stage, because over the last few months, despite geopolitical tension in various parts of the world, gold prices have not moved up very substantially. We'll also talk about your strategy when it comes to silver, because a lot of people have been talking about silver versus gold. Usually there is a ratio that describes the value of gold versus value of silver, and it is actually the gap between the two is widened quite considerably. Will that gap be closed, and does that provide an opportunity for you? We'll talk about that as well. Joining me today is CA Abhishek Mehta, who is the founder of Invests Capital. Thanks so much, Abhishek, for taking the time. Let's talk about the performance of gold. Of course, you've probably been studying it for some time. Why is it outperformed?
So in the last 10 years, if you see, there are three major reasons why gold has outperformed the Nifty 50. One of the first major reason is there is a heavy buying from the central banks. If you see, China has added almost about more than 500 tons gold in the last decade, and even Russia has added more than 900 tons in their reserves of gold. 1/5 of the gold reserves today are holded by the central banks. And Russia has been one of the key players in adding gold reserves in their kitty. The reason is that China today, if you see China's numbers, China today ranks second in terms of GDP. It is second in terms of military forces. It is second in terms of foreign reserves. It is second in terms of market capitalization. But still, in terms of gold reserves, it is almost at the rank of sixth right now. So my estimate is that even though the last decade has been very good for gold, another 1 decade, like in the next 10 years, Russia and China together will be adding a lot of gold in their gold reserves because they would like to de-dollarize the foreign exchanges and get their currency stronger as compared to dollar. So that is one of the key reasons why gold has performed. The second reason has been, or obviously in the last 3 years, we have seen a pretty good bull run in the gold market. The geopolitical tensions, whenever geopolitical tensions arise, obviously gold is known as a heaven and everybody moves to gold, whether it is US-China trade war, whether it's Russia-Ukraine, whether it's India-Pakistan, all the wars have led to the increase in gold prices. Third reason is always gold is a very good hedge against inflation. So whenever, like we also do asset allocation, we tell clients ki invest some amount of bit of your money into gold because it is one of the best asset classes to hedge yourself against the gold.
Okay. So those are three reasons why gold has outperformed. Now, I do want to ask about the best way to buy it though, because Abhishek, and I know this conversation has happened so many times, even I have had this conversation several times, but it bears repeating. A lot of people think that investing in gold is going out and buying gold jewelry. Now, there are so many digital options available. Unfortunately, the sovereign gold bond is no longer available. So with that knowledge, what is the best way to invest in gold? Would it be through the gold ETF?
So before we jump into how to invest, I would also like to, talk about the risk before.
Sure.
I personally believe that once we go into an asset class, first let's talk about the risk. If you see the standard deviation of gold over the last 10 years, it is about 18.25%, whereas silver is 23.75%, which means silver has a higher volatility rate. So whenever you are choosing between the two asset classes, whether it's gold and silver, be aware that you will face more volatility in terms of silver. So silver should always be bought in a staggered manner. Now, how can one invest into gold and silver? There are two major methods. One is ETF and second is fund of fund. ETFs is a very good method. You can probably purchase 100, 200 rupees also, 500 bucks also. Lot of time investors confuse that their actual physical gold returns and the online gold returns will be same, but that will not be the case because of three major reasons. One, when you go and purchase from a retail shop, you have to pay GST. Second, you have to pay making charges. Third, your retail gold prices are always higher as compared to wholesale rate prices. So I would like to urge all investors, if you are going and purchasing gold as an investment asset class, always go for ETFs or fund of fund, and especially for silver, go in a very staggered manner because silver has a very high volatility rate as compared to gold.
I want you to describe this. Now, a lot of students of mathematics or even economics will understand what you say when you say standard deviation. But
Yes.
from the perspective of price movement over the course of 10 years,
Yes.
what this would mean is that there could be a deviation at any given point of time up or down by as much as 18% from the long period average. Is this correct?
Right, right. So I always, in a simple manner, it is the turbulence which you face. So when you catch a flight, the amount of turbulence you will face from going to your destination A to B. So gold will give you a turbulence of about 18.25%. Consider it as a pendulum. So it can go 18.25% down, it can go 18.25% up. And silver will give you a turbulence of 23.75% when you are going from one destination to another.
So we've established what that is, and in the meanwhile, the Nifty 50 total return index had a standard deviation of 12.6%, which is at any given point of time, it will still give you a positive return even in a lean period, whereas a gold investment at some point of time you could turn negative over the course of that 10-year period. Basically, this is what it means. But you've also told me about the efficiency ratio. What do you mean by that?
Efficiency ratio basically means for every 1 unit of risk you are taking, what is the return you are generating. So it is basically return divided by the standard deviation. It just gives you that whether my risk was perfectly correlated with the return or not. So Nifty 50, if you will see, the efficiency ratio turns up to 1.04%. For Nifty 500 index, it turns up to 0.92. For gold, it is 0.76, and for silver, it is 0.48. So silver has the least efficiency ratio because of the higher volatility rate. And also silver in the recent year has not underperformed, but to its peer, it has not performed that good as compared to gold. But I personally feel that in coming next 10 years, silver might be a very good asset class because it has gone away from the precious metal. Nowadays, silver is being used in a lot of things like EVs, solar, your medical devices. So I personally feel that in the next decade, silver would be an asset class which will outperform gold in a period of next 10 years.
Okay, so and that's an important point that you make, because we're looking at all of this in the rearview mirror, Abhishek, and
Yes.
we've seen a tremendous rally for gold as things stand right now. Like I said, that gold-silver ratio is at the widest that it has been in a long time, and so from that perspective, what you're saying makes sense. We could see a rally in silver prices, and so if we have a conversation 1 year from now, maybe the figures that we've just spoken about will be different. But having said that, what you just referred to, I was reading that that 2/3 of demand for silver actually comes from industrial sources. So exactly what you're saying. And so when demand goes through for industrial sources of silver and supply constraints are resolved to a certain extent, you can actually see a rise in silver prices as well. But having said that, how should an investor invest in silver? To what extent should they invest in silver and gold?
I think you can invest almost about 10 to 15% of your wealth into commodities like gold and silver. Like I said, one of the best ways to do it, not through the physical channel, but through ETF and fund of fund. What's the difference between ETF and fund of fund is more or less on the taxation part. ETFs are more better as compared to fund of fund because ETFs will give you a 12.5% taxation after a year, and fund of fund will give you a 12.5% taxation after 24 months. So the best way to invest into gold or silver, I think probably you can buy silver Bs and gold Bs through the ETF channel, and it will give you a taxation of only 12.5% after a year. Also, physical holding, has a lot of hassles, Alex, because every time you want to go and sell, you have to go out to your house, you have to find the rates, then sell it out, and the liquidity becomes an issue. Whereas the liquidity is much better in terms of ETFs. You can just go on your app or call your broker and sell those ETFs very easily. I would also like to point out one thing is gold and silver has a negative correlation with Nifty 50. What does negative correlation means? Whenever Nifty is negative, gold outperforms Nifty. So if you see the past data, let's look at some data. In 2003, Nifty was down by 11.7%, but gold was up by 8.4%. In 2009, Nifty was down by 35% and gold was up by 26.80%. What does this means is that you should not put all your eggs in one basket. The negative correlation in an asset class is very good because when one asset doesn't perform, the second asset class will perform. So that will reduce your volatility in the portfolio level and give you a better returns.
Okay, quick question on this and then we move into asset allocation. When you're buying an ETF, what is the efficiency of the ETF? And by that I mean in terms of pricing. For example, if I go to Zaveri Bazaar and if I were to look at the value of gold, they will give me the market rate. But on an ETF, there is sometimes a dislocation and it's not exactly that same price. How likely am I to get the market value as close to market value when I'm buying gold on an ETF?
So in fact, the efficiency is much better when you are buying, because when you go to a wholesaler or retailer, he obviously keeps his spread. Whenever he's buying, he's selling probably $1,000, lower, and whenever he's selling, he's charging you $1,000 more. So more or less, you would get a 99.99% efficiency when you are buying an ETF as compared to physically going and getting the gold.
Okay, got it.